So basically, today we are going to talk about the CVC and how the CVC is shaping the market, how the funding from the CVC perspective is shaping the market. But before we go there, I'm not aware who is on the audience. Maybe we should start from the definition, right? We have this off-stage conversation with Alina. So maybe we can start from you, Alina. Maybe we should set up the stage and say what is really the CVC in the beginning.
Hi. I think we need to actually discuss it before we go into saying is it good or bad, because it's quite a new concept in Poland, but worldwide as well. And there is, let's say, a lot of questions about how this can work. Is it a good thing or not a good thing? But I will tell what we do so that you guys have an idea of how this can work. Innogy Innovation Hub was set up 5 years ago by Innogy as a way to invest in the future, of how the future of energy can look. We invest in startups, actually cash for equity. We help them. We have 4 investment focus areas. 3 of them are very far away from energy. One is PropTech, cybersecurity for utilities, machine economy, and disruptive digital. This one is about energy. We have so far invested in 90 startups. The value of the portfolio is around 165 million euro. And we keep on investing. So we have, let's say, quite an experience going up and down in our CVC of what a CVC is. And we also know the challenges of working with a corporate.
Cool, thanks, Alina. So Bartek, you are running the CVC for PGE. Is your definition of CVC similar? Is it one of the definition of CVC, or do you have a different one?
From the theoretical point of view, there is a matrix presenting how close you are to the funding company, or how far you are from them, or what kind of investment do you do. I prefer more independent type. I'm not referring to you. I'm just saying more independent type of investment. I think that it's better if it's given to independent, when the investment is given to independent team, than when it's done internally. It can be better, and let me explain you why. Many disruptive changes. Disruptive is a very overused word, but still we are using it. But many disruptive changes, or most of them, are against current business. So current business owners it's very difficult for them to do the things which are against their business, which is against what they've been doing for years and been doing very well. So I really doubt that internal investment team, as an opposite to external CVC, can invest in really disruptive changes. It's impossible, in my opinion.
It's an interesting topic. So maybe we can go further, and we hear a lot of opinions about CVCs, and there's a recent one from the prominent CVC venture from States that. And this is a quote, that CVC basically kills the startup, and the corporate should focus on their core activity, right? So instead of just spending money making money from the CVC investments, but on the other hand, you have this common belief that the VCs are actually just intermediaries of the in the stages of the corporate of the startup life cycle, right? So maybe Grzegorz, I think you can tell from the startup perspective, right, how you see this topic.
Okay, so first of all, I would be very cautious if I would be putting all CVCs into one basket, because this is not the case. I mean, as there are so many different corporations on the market, each of them has completely different profile, different industry, different background, different market position. So basically, the moment they come up with the concept of CVC also is completely different. And that impacts the strategy, the founding factor why the CVC has been created. And this is also very important, who made the decision, who is on board of this kind of vehicle. And actually, the first thing to ask always is, why you have this vehicle and where do you want to move forward with it? And I have seen basically two models. One model is exactly as you said, that it is like a corporate arm to do some innovation which internal team is unable to do. And the second type is, much more open. Simply, we got a very healthy profit. We would like to do some investments into new areas, which they do not need to be fully in line with what we currently do. But if they are part of the ecosystem we do, it's the best case. Because then we can support those businesses with our insights, with our team, etc. So for me, it's always to understand which case is it out of those two. And from the startup perspective, obviously, it's an obvious answer that you always need to understand who you're dealing with. And it's the same type of question you ask to typical VCs or the typical angel investors, why do you want to invest? And based on this answer, you can judge. Other than that, it's just, gambling. Especially that on typical VCs, you are usually very transparent on the strategy. You know that the best option is simply the exit based on the exit from the company. While for the CVCs, sometimes this is not the case. Sometimes the investment is just to acquire a new part of the market share. Sometimes it is just to block the competitors from achieving some part of the market share. And this all is very important. And one of the most typical questions which is asked, if I want to cooperate with a given CVC, does it open the market to new opportunities, or does it close the opportunities, especially for the competitors? And I've seen many investors, and each of them has a little bit different answer to that question. So never judge the book by the cover, I would say.
It always depends.
It always depends. I mean, it always get into insights why this vehicle is moving forward, and assess whether it has four wheels or maybe more.
Wojtek, what do you think? Should startups focus on their core activity? I mean, the corporations should focus on their core activity, or should they really invest and open up for startups investments?
Of course, they should invest because this will help these companies in build competitive advantage. Most of big companies think that they will find disruptive innovations outside their market and outside their company. So the good way to find such innovations is to look at the startups. Of course, not every corporation is properly prepared to start such corporations. So we are trying to educate how to do it in the right way, how to prepare various types of instruments that will support this process of collaboration step by step. Because I'm seeing that a lot of companies think that they can build their corporate venture capital arm, and that will be the point of start for them to work with the startups. And this is the last step that they should make. So we are trying to show that at the beginning you should focus on work with some partners that will teach you how to select the proper startups, how to start this cooperation. And then when your team will be ready enough to make it by your own, then you can make such activities. And in my opinion, this is the right way how this process should be organized in corporations.
Thanks. I think from the corporation perspective, it's always also sometimes good for PR, right? So to create those kind of things. So Alina, how it looked like in your fund, right? Do you think the VCs versus CVCs? What are the advantages for the CVC model?
So I think I agree with you, and it depends very much on what the CVC model is. In our case, we are a mixture of ex-Innogy guys and external people, external experts, so we behave more as like a VC rather than a corporate, cell that tries to engage with the outside world. Couple of benefits that we see that we provide to the startups, and we have to prove every single time they actually do provide it, because they test us out. There is enough of money out there, so you have to really deliver what you say. But those benefits, for example, is we try to get POCs and paid implementations for our startups with the core business. I am saying we try. It doesn't mean we never promise anything, and it's not always possible, because the big challenge working with either CVC or not CVC is the startup versus corporate. That's like a clash, you know, a David and Goliath, and that you need to be very careful. So this can be POCs, this can be paid implementations. We also have, given we have international network, we have offices in 5 different markets, we can also support different geographies for the startups. So in my case, I have a couple of startups in Israel and in Finland. For both of them, the local market is far too small. So we support them in going into US or going into Germany or UK, which are typically the markets they want to do, and we actually can do it. And given also that we invest in things that are not so straightforward energy related, like PropTech, we are a not competitive player to any of the big PropTech guys, let's say CBRE's Eco Investment of this world, Budimex. But because we are this odd guy who does something in PropTech, and by the way has a big brand name from Germany of the big energy company with 40 million customers, then sometimes, I mean, we do try to open doors for our startups. So I would say there are benefits of like growth for the startups, and we also think, we like to think of ourselves as strategic investors. So we are there not for a short run. It is not to make Innogy richer in the next 2 years. That's not the purpose. But the purpose is to really see which of those business models will become closer to us in the future.
So Alina, you touch upon all the benefits that might emerge from this CVC cooperation with the startups. I think it's a great topic, and we can go back to that. But before that, I would like to ask Bartek, what is your opinion about these intermediaries? Do you think, you know, the VCs, you have experience for both, right? From the startup perspective, from VC and now CVC. Do you think VCs are intermediaries? What are the advantages of the CVC's model here?
Well, I think Alina has mentioned a few, but first of all, I'm always taking an entrepreneur perspective. So we are willing to invest in best entrepreneurs. And of course, most of the best entrepreneurs, vast majority of them, are very independent. So if they will feel that the investor wants to hire them rather than invest in their company, they will never agree on that. So I think being CVC, and from the investor point of view, from our investor point of view, from PGE, is that we are not hiring people for them. We are creating businesses which maybe they will be able to buy in the future, not get in the future, but we also give them the access to the newest technologies, and to the technologies that probably will be difficult to implement inside the organization without us. So as Alina says, the POC, the proof of concepts, the first implementations, or even the access to the knowledge from the startup perspective is great. But on the other hand, startup is always afraid that I will lose my independence. Because if you are an entrepreneur and somebody invests in you, you're also thinking about your personal return on investment. So if you have CVC on the board, you have to be sure that your potential exit would not be limited by some things that, well, maybe I'll buy you cheaper. Nobody wants that. And really top-notch entrepreneurs will never agree on that. So this is a challenge for organization to understand that and to do it. And I'm, of course, grateful that our investor understands that. But it's not an easy point, let's be honest. But from the entrepreneur point of view, he will always take the money he perceives as the best. And it's not always about valuation. If we, as a CVC, can deliver them some extra things like implementations, POCs, access to knowledge, introductions, this is the value of CVC, I think.
So Grzegorz, what do you think about, from perspective working with the corporations? I know that you have POCs with one of the major banks and a lot of things coming in. So what is your perspective about the opportunities of working with the CVCs with the corporation?
So first of all, I completely agree with you. So for entrepreneurs, it's always about independence, and it's just a value which is very hardly tradable. So once you trade it, it's gone. So sometimes it's not real, but it's simply in the mindset. And my perspective is always that if you do business, you don't want to see the roadblocks all the way you go through, because then you need to find other solutions. So you always ask a CVC, how do you feel if I cooperate with your competition? That's question number one. And this tells you basically the story or the motivation, what is the investment. Second thing is, as you mentioned, there is a shortcut in terms of access to the market with the CVC. And sometimes in some industries, especially the heavy regulated industries, it is much easier to go for expansion with one market player, prove the concept that it's workable, and then under the condition that it can be expanded also with other competitors, because it makes a business for both parties, then it's a doable solution. But this is case by case, and sometimes it's really faster with the CVC. So like the typical VC, what can they do? They can introduce you to a customer, but they cannot influence a decision at all. CVC, contrary, although usually they do not promise anything, but they can give you very close perspective and insights, where basically if you fail to make a deal, it means simply that your business is too weak for the given CVC. And this verification is very short. I've seen a lot of examples where simply with the introductions of VCs, it's simply just an introduction, and with CVCs, it comes with far better understanding of the insights of the business that you have, which gives you additional value. So I wouldn't say that this is one way or the other, but I would say that it's very important to understand what you as an entrepreneur look for. And in certain situations, I believe CVCs are better. Now, there is one trick indeed, that if you are looking from the perspective of valuation, that usually, and this is based on evidence, that usually if you go to the path with VC and then you go to sell your stake or exit fully to the CVC, the valuation is usually higher. That's from the benchmarks. But the question is, if you are actually able to create a given amount of business only by having financial resources. And my perspective is that financial resources is just a resource as any other, while most important part is the team who is backing you up. So for example, where we were choosing investors, we're looking exactly at the team, what are they best in, can they show us typical benchmarks from the market, can they introduce us to other companies from the similar companies that we can learn from them, can they introduce, can they put their credibility also on the shelf when needed? And this is, very important. And once you sort it out, then basically the decision is simple. And I would say it's always up to the team. So if you ask me about, one or second CVC just by brand, I can tell you nothing about it. If I go and visit the team and see how they react to some answers to questions, some questions should be provocative even, then you understand who you're dealing with, and then you can make a smart decision.
It's a very interesting perspective from startup, right? So how to see that. So maybe I have a question to you, Wojciech. In your recent book, Corporate Startup, you talk about startup collaboration readiness, right? So the question is, when is a great moment? Where is a good moment for startups to actually be involved in such deals?
So startup thinks that they are ready enough from the day zero to start cooperation with large entities, and we know that this is not true because they should understand what are the needs of the corporation. So, and on the other hand, the corporation should understand what are the expectations of the startups from such partnership. So, in my opinion, it's good to just check what those companies, the big ones, are doing, if they are making something that could be interesting from our perspective as a factor to grow. What is their history of cooperation with the other startups? Yeah, we should ask some founders that started a conversation with such companies about their experience, about the results of such partnership, and then decide if this partner is proper for our company. Of course, it's good to find some kind of middleman that will be a bridge for such cooperation, like, for example, acceleration programs like ours. But also startups try independently to catch those corporations, to attract them with their ideas. And visiting some meetups, events, and using the opportunities to meet the people from the other side is always good to just plant some seed for this further cooperation, because it will take a time to convince the corporation that this startup is good enough to make something together, and will take a time to convince them that our technology, our team is ready enough to help this corporation to solve some of their problems. Yeah, so this is not something quick, and startups are working in short sprints. They are very agile, they are very flexible, and things that the big guys are also ready to make this process very short, and this is not true. Startups should understand that the way how the big guys are working is totally different than the startup way, but there is a lot of opportunities to make this cooperation happen.
So we see a lot of things, yesterday we talked about that, there's a lot of advice on how to start, how to, to pitch to corporation or to sell to corporation, right? But there's not a lot of information how to keep the relationship with the corporation last, right? There's a changing boards, changing priorities, quarterly results, right? So in this context, right? So my thoughts are going to the to the end of the cooperation, right? Eventually, every startup like every VC or CVC want to exit, want make some money. Like corporation want to make the good partnerships, hopefully strategically for their business. So what are your thoughts in terms of CVC versus VCs in terms of the end of the cooperation, exit, right? Like you started to talk about that, Bartek. So maybe you could start.
I don't think like there should be any difference. I mean, it needs to end with creating a value and monetizing the value, and it cannot be different. And so that's, I'm deeply convinced that it shouldn't be any different. So even if you represent a big, so I'll give you the example. In most of the cases, like Intel is having its CVC and it's acquiring the company from its CVC. They are paying a price for the company, and they are paying a market price for the company, because they are usually they are not the only investor. The entrepreneur also wants to make money. So you may perceive it fair or not, but it needs to finish the same way. Of course, the corporation which invests in CVC has got a huge advantage because they have a full knowledge about the company. So they've been with them for 10 years. They know how they how they perform. They know whether the CEO is a good guy or a good lady, or or sometimes freaking out or whatever. So I think there's a huge advantage in knowledge, but not in price. That's what I would say.
I agree. I would also say one of our KPIs is how is the valuation of our startups doing. So we are the same like any VC. I mean, we better make sure there is enough investors for the next round and the valuation is up. So I fully agree with Bartek. It's actually the same.
You know, my perspective is the following, also coming back a little bit to the previous question. So indeed, the best case scenario is if you are a startup, you have in your shareholders not just one CVC, but you have VCs and a CVC, because that's a perfect match. Because you have value-added industry possibilities, and you have, on the corporate side, you have a balance. You know, the shareholders agreement is far better for you because you have options which you wouldn't have if you go directly only for the CVC. I mean, with the assumption that obviously it may change CVC to CVC depending on the strategy. Now, the second thing is indeed that the value is lying in the business. So taking a little bit different perspective, where when I was managing the Allegro group, we had over 60 investments in Central and Eastern Europe. And obviously, when you have 60 businesses, there is a different performance. Some companies are overperforming, some companies are underperforming, and basically, then there is a luxury of options, because if you have a CVC, because if you see that your business is going great, and your CVC sees that if they don't buy you out at a good price, you are actually can be, in many cases, a good competitor for them. And this triggers really what Bartosz mentioned, market valuation. But this is only under condition that the business is good. When the business is not going well, indeed, that's the opposite side, because obviously you have less options on the table. But come on, who would discuss the businesses which are not performing well? We all think only on the positive side, and simply that's what needs to be the mindset. So sometimes things are not getting fine in the first part of the time plan, but after you make some corrections, it's going better.
Guys, you have a huge experience in working with startups and building great value for the corporation and so on. We have 1 minute, 30 seconds till the end. Maybe just closing thoughts about maybe advice for the startups. Advice for the startups in the context of raising money. Maybe let's limit this to this, because probably you have a lot of to advise on. But closing thoughts about raising money for startups.
Maybe I start. I would say check out your partner, because CVC is quite new, and always check if it's CVC or VC. You better check who are going to be in the relationship for years to come. There is a risk of working with the corporate world in general. So if you talk to a CVC probed on that specifically, how is that going to work? Because that's potentially the area that it can be difficult, or it can be easy, right? But that would be my my advice.
So my advice is very simple. Just investor is just a solution. On maybe it's another brick in the wall, but it's not goal itself. So funding doesn't solve all your problems. It's just the beginning of your problems, being honest. So I would say raise as late as possible. So if you can grow your company without external money, it's better. So choose wisely your partner and use the money if they can accelerate your business, not to have an investor, because it's not just for its sake.
Just one sentence. I would think of investors as your business partners. If you are able to do good business for them, they will do good business for you.
I will add something more. Don't think about raising money. Think about how to use the resources of the corporation to build your business.
Thank you so much. That's a great discussion and a lot of insights. Thank you so much.